Hi everyone. This is Tony Marino with Guild Mortgage, and we have a great class today that Glenn is presenting. He will be going over the 2-1 buy down and showing you how to educate your sellers on if they were to pay a buy down fee, they can offer any buyer a mortgage interest rate 2% less in the first year and 1% less in the second year. So if they had a 6.5, their first year would be 4.5. And instead of paying 6.5, their mortgage would be paying 5.5%. This could help with selling the home quicker and not having to reduce the price at all. So, with that being said, I'll turn it over to Glenn to present everything.
Well, thank you, Tony. And I just want to reiterate what Tony just said. We think it's a strategy that many realtors don't know about. And I think the easier strategy that we've seen realtors use is let's do a price reduction. The house isn't selling as fast here in the fall and winter markets. So let's just do price reduction. And what we're trying to do here is show you that a price reduction to a buyer is not that great of an incentive. Dropping the price, say some $10,000, is not as big of an incentive as dropping the interest rate. If interest rates are in the mid sixes right now, what's exciting to a buyer, which helps, I'm going to make a seller's listing unique. If they can put into the MLS, into the remarks section, that the interest rate could be as low as 2% lower, around 4.5% in the first year, and then 5.5% in the second year. That's going to make that listing stand out, especially when they're looking at two or three different homes. Which one do we take a look at? If it's going to save them thousands of dollars, in the first 2 years, they're likely to favor that listing. So let's get into it a little bit more. Let's show you some of the specifics. This is not a long webinar, but it is a very important webinar. So again, you've already been introduced to Tony Marino, our branch manager in Naperville, Illinois. But let's talk about the real estate market. What do we know about it right now? Well, homes are sitting on the market longer as cautious buyers remain on the sideline. It's just logical. The busiest times that homes sell and they sell quickly is April through June. That's the time where mom and dad want to buy a new home. They want to get their children enrolled in the next school year. So there's kind of a bigger rush to buy homes in that period. But we're in September. We're leading into October, November. As we all know, it's more seasonal, it's slower. And how do we get our listings to sell faster? Because the median time on the market has reached 58 days nationally. Some markets going to be shorter, some markets longer, but the average right now is around 58 days. There's the lack of significant buyer response to substantial gains in for sale inventory that has pushed many sellers to reduce prices. And this is being said by Jake Krimmel, the senior economist at Realtor.com. So what that means is, we're seeing price reductions as the incentive for those homes that are on the market. He goes on to say the price reduction share reached roughly 1 in 5 homes in June. That's the highest share of price reductions in the data's history. It also comes at a time when mortgage interest rates remain too high to make home buying affordable. As of Friday, September the 12th, 2025, the average 30-year fixed rate in Illinois is 6.44 according to Zillow and 6.44 according to Bankrate. So again, if you currently have a 3% mortgage loan, you would be more than doubling your interest rate if you went to 6.44. You'd be doubling your current mortgage payment. So to avoid this, some buyers remain on the sidelines or they opt to do a home improvement. But what incentive do we have as realtors to get them off the sideline? So even if you're not so much a listing agent, as a buyer's agent, you can also take some of your prospects and use this strategy that we're about to talk about to see if they would move forward. Would buyers move forward if they could get a rate of 4.5% in today's marketplace? What else do we know about the real estate market and mortgage interest rates? Well, we currently know they're in the mid 6 range. In in his widely anticipated speech at Jackson Hole on August 22nd, just last month, Fed Chairman Jerome Powell signaled the possibility of interest rate cuts, stating the Fed was in a challenging situation with increasing downside risk to employment alongside rising inflation. He indicated the Fed may need to cut rates possibly as soon as their September meeting this month. There could be the possibility of rate cuts, and acknowledged that tariff impacts are still working through supply chains. There is the possibility of interest rates cuts coming also in October and in December. Chairman Powell will be inclined to cut interest rates if the labor market continues to decline like it did in July. So if we see a softening labor market and we see that inflation is staying down, just a couple of days ago, they came out with the consumer price index year over year. It was something like 2.3%. The estimate was also 2.3. So inflation is keeping its ugly head down. That gives the Fed reasons to cut rates. They raised rates because inflation was at all-time highs. But now that inflation seems to be staying under control, they're looking hard at the labor market. And if the labor market continues to decline, the Fed will definitely be cutting interest rates. This action, this conversation that Chairman Powell has talked about, has caused the stock market to roar because they believe that rates are going to be cut. And the Dow Jones Industrial Averages increased 846 points on August 22nd and increased 617 points on September 11th. So the market is already baking in, is already anticipating that there's going to be some rate cuts. Why do we bring this up? Because again, if a buyer is in the marketplace, would be in the marketplace if rates were lower, why not look at this 2-1 buy down situation where they get 2% less in the first year, so they're down to 4.5%. And what if rates come down to the 4.5% range, where they can then refinance in the second year? But if they don't, their rate would only be 5.5% in the second year in our example. And then again, they can refinance in that second year or going into the third year. So it's important to understand that there is, the real possibility where we're heading in the next couple of years is for rates to start to come down. Mortgage rates will start to come down. And therefore, this strategy of giving people 2% lower rates in the first year, 1% in the second year, that should be very exciting, not only to buyers, but also to sellers. For you listing agents, by putting those remarks into the MLS, that the seller is willing to pay the buy down fee to lower any buyer's interest rate, 2% in the first year, 1% in the second year, that's going to make that listing stand out and get some traction. What do we know or anticipate with mortgage interest rates? Well, the interest rates cuts will not be robust, but rather, say, 0.25% decrease each time the Federal Reserve Board meets. This trend is good for real estate. It will bring more buyers to the table, but you'll bring more buyers if you educate them and let them know today they can get in the mid-4s instead of the mid-6s. This is good news for buyers that mortgage interest rates are likely to drop. However, is it enough to bring buyers back to the market? Not just that the rates are inclined to drop in the future, but the mere fact is that if you can tell your prospects that they'll receive 2% decrease in the first year and 1% in the second year, that would be a big incentive. That will get buyers' attention. That will get listings' attention. Knowing or believing that interest rates will be lower in the next 2 years, which I think we all do, your client could take advantage of a 2-1 temporary buy down and then refinance in the third year in a much lower interest rate environment. This might be the incentive to get your prospects off the sidelines and back into the real estate market. It might be the incentive that sells that listing because the other listing that, say, a potential buyer is looking at is not offering a 2% buy down of the interest rate. There's a temporary buy down cash deposit that has to be paid to get these lower interest rates. What if you advise the seller, who within 58 days of being on the market will most likely talk to you about a price reduction of, say, 10,000, 25,000 or more, and you suggest, in lieu of a price reduction, you ask the seller to pay a temporary buy down cash deposit and advertise it in their MLS listing. You will see, as we go through this example in future slides here, that the cost of the buy down cash deposit is less than that price reduction that they might be talking about. So what is a temporary buy down? Well, as we mentioned, buyers can buy down their mortgage payment for up to 3 years at the beginning of the loan. Lower payments in the beginning years can help free up cash flow for home improvements and more, or just make their household budget more affordable. It can be used for primary purchases of a single family residence, a PUD is a townhouse, or a condo. You can use this 2-1 buy down on conventional loans, FHA loans, and VA loans. And like we said, it can reduce the payments for 12 months if you just want to do a 1-0 buy down, for 24 months if you want to do a 2-1 buy down, or it can be 36 months if you want to do a 3-2-1 buy down. The most attractive one, the one that we see most often used, is the 2-1 buy down, or the reduction of the mortgage payment for 24 months. What is a temporary buy down? It's a mortgage financing strategy that temporarily lowers the interest rates for the first 1 to 3 years. And again, the most sought after used one is the one that lowers it for the first 2 years. There's a lump sum that's deposited into an escrow account at closing to subsidize the payments. And this lump sum can be paid by the seller, the builder, who is a seller also, the lender, or the borrower. You'll be pleased to know that many sellers, if they put the 2-1 buy down into the MLS in lieu of a price reduction, they're going to get much more activity, much more traction. And you're also going to find out that it's unique just to Guild Mortgage, that Guild Mortgage will pay the buy down fee for the second year on a 2-1 buy down, and on a 1-0 buy down, they will pay that buy down fee. And we're going to show you that in a second. Some common types of buy downs we've talked about. There's the 3-2-1 that reduces the rate 3%, 2%, and 1% over that 3-year period. The 2-1 buy down, it reduces it 2%, then 1% in the second year, highlighting that contact Tony Marino at Guild Mortgage, because Guild will pay for the buy down escrow fee in that second year. So when we look at how to calculate that fee, that second year, it can be and will be paid by Guild if you go through Tony Marino. The 1-0 buy down, where the rate is just reduced 1% for the first year. Again, through Tony, Guild Mortgage will pay for that buy down escrow fee, and the seller doesn't have to come up with any funds. So here's the 2-1, the most attractive, the most used buy down in action. The original note, let's say, is 6.5%, which again, 30-year fixed rate, great. For those that can't afford it within their budget, they pay the 6.5% interest. If the loan amount is $400,000, the year one rate would be 2% less of 6.5, or they would get 4.5. In the second year, it's going to be 5.5, which is 1% less. And in year 3 through 30, it's going to be then the going rate of 6.5%. Makes sense. So what are the benefits for the home buyer? Well, it's increased affordability. They've got lower initial payments. If they say, oh my gosh, it's 6.5, it's just too rich for my household budget, but at 4.5, I can afford to make those payments. They make the offer closer to the listing price. As a home buyer, if you make the offer closer to the listing price, provided that the seller pays the buy down escrow fee, great strategy. You can always make your offer if the seller is not offering already in the MLS to pay the buy down fee. You as realtors can advise your client to make an offer closer to the listing price, but then put in there that the seller must pay the 2-1 buy down fee. Or if your negotiations, your table of expectation is agreed upon. Say, for example, buyer and seller agree at $380,000 on a $400,000 listing. You can go back as the buyer's agent and say, no, my client wants to offer more. He wants to offer not 380, but $390,000, provided the seller will pay the escrow buy down fee. Again, a great way of looking at it. They already have had a table of expectations set. The seller thought they were going to get 380. They're now getting 390 minus the buy down escrow fee, which will still net them down close to the 380. Benefits to the home buyer: Guild Mortgage will pay the buy down escrow fee in the second year on a 2-1 buy down. That's attractive. Or they'll pay the complete buy down escrow fee on a 1-0 buy down. Another benefit for the home buyer is it gives them breathing room. It gives the home buyer time to adjust finances. If it's 2% lower in the first year, well, over the next 2 years, the likelihood is that they're going to get an increase in salary. They can work on their credit. If their credit score was, say, 680, but they want to move it up to 720 to 780, so that by the time they refinance, they're going to get the best interest rate available in the marketplace. This is a great way. It gives them breathing room to work on finances and their credit. And the benefit is there's the potential for refinancing if and when rates drop. But again, we think that there's going to be a reduction in mortgage interest rates over the next 2 years, and that if the seller believes that, notes need to go into the MLS that they're offering to pay the buy down fee. If we all believe that rates are coming down, the buyer agents need to educate their buyers that they can get 2% less in the very first year. Benefits for the seller: well, marketability. It makes the property more attractive. All the buyer agents are going into the MLS and looking for, potential homes for their buyers to go look at. But if you're advertising in the MLS that your seller is willing to bring the rate down 2% in the first year, and that they're going to pay the buy down fee, that's going to attract more buyers. It speeds up the sale. It alleviates buyers' concerns. If buyers are concerned at 6.5%, they're going to be less concerned at 4.5%. It's a cost-effective incentive versus a price reduction. We're all in this real estate market. If I took a $400,000 home and I reduced it to $390,000, the impact on my mortgage payment is minimal. But if you're all of a sudden buying down my interest rate by 2% and then 1%, you're saving me thousands of dollars in the first 2 years. That's going to be a very cost-effective incentive for me to move forward. Considerations and potential drawbacks. Well, the buyers must prepare for higher payments after the buy down ends. That means that at the end of 2 years, if in fact rates have not dropped, in our example, that's 6.5%. That was 4.5% in the first year, 5.5% in the second year. It will now be 6.5% years 3 through 30. The loan qualification is based on the full rate. So even though they get a pay rate of 4.5%, they will be qualified by underwriting at 6.5%, because eventually the note rate does go back up to 6.5% starting in the third year. And refinancing is not guaranteed. If their credit deteriorates, if they take a bankruptcy, if one of the borrowers loses a job, then there is no guarantee that there's going to be a refinancing starting in either the second or third year. So how does the escrow account work? Well, the seller or the builder or the borrower deposits funds into the escrow. The escrow account releases funds monthly back to the lender to make up for the difference between 6.5 and 4.5. The lender receives the subsidy covering the payment difference between 6.5 and 4.5. So let's take a look at it on our buy down sheet, what this really means. So here we have a 2-1 buy down scenario. The loan amount is $375,000. The note rate is 6.5. So in year one, they're going to get 4.5%. So the total monthly payment at 6.5 is $2,370. At 4.5, it's $1,900. They save monthly $470. Realtors, if you show that to buyers, they're going to get a little more excited about saying, maybe we should go out and look at houses. Maybe we should get off the sidelines, because it's going to mean for them $5,642 in savings for the entire year. In the second year, when the rate is 5.5, well, the note rate of 6.5 is again the $2,370. They're going to pay only $2,129, a savings each month of $241, or to almost $2,900 is what they would save. They would save for the first 2 years $8,535. That is the buy down fee. But remember what Tony Marino and Guild Mortgage will do. They will pay the $2,892 if you use this strategy. So, listing agents, pay attention here, lean in. All you have to do is get your seller to agree. Again, the numbers change if it's not a $375 loan amount, but you have to let them know, are you willing to pay the fee of $5,642 in this example in order for us to attract more buyers? Let's not do a $10,000 price reduction. Let's advertise that we're willing to pay a buy down fee to give any buyer 2% less in interest rate in the first year, 1% less in the second year. And the second year fee is paid by Tony Marino and Guild Mortgage. Here's another example of the 1-0 buy down. And what do we learn about the 1-0? This fee is paid entirely by Tony Marino and Guild Mortgage. But in the first year, the rate would be 5.5. Again, if they believe that rates are going to come down quickly, they don't want the 2-1. They just need a subsidy for the first year. The monthly payment on a $350,000 loan at 6.5 would be $2,212. The payment that they would make at 5.5 is $1,987. The borrower would save $225 a month, or almost $2,700 a year. And who paid that? Guild Mortgage. I mean, it's a great opportunity for listing agents to put this into the MLS. It's a great opportunity for buying agents to educate your buyers, your prospects, those that say, oh, I think I'm going to wait. I hear rates are going to come down. Why not take advantage of now the rates are down? And if they do come down in 2 years, refinance into a much lower interest rate. The bottom line, is it right for you? The buyers benefits from lower initial payments in the first 2 years. Sellers benefit from faster sales and better marketability because it's in the MLS, it's in the notes. It's there for other realtors to mention. It's for you to put into your social media posts that this beautiful home is also going to buy down. The seller's going to buy down the interest rate of any borrower 2% in the first year, 1% in the second year. Who wants a co-branded temporary buy down flyer? Tony has flyers that he can give to you that you can start handing out in your listing presentations. You can also be handing it out to your buyers as you go and show them different homes. Or if you like that Excel buy down worksheet, we can also send that to you so you can actually play around with it, put in different interest rates, and see what the buy down fee. But please note and remember that Guild Mortgage pays for that second year on a 2-1 buy down. They pay the fee. And on the 1-0 buy down, Guild Mortgage pays the entire fee. Speak with Tony, the branch manager, for personalized advice. He's at 847-804-1059. or you can email Tony at tony.marino@guildmortgage.net. Again, this is not a commitment to lend. It's for informational purposes. Again, I'll take any questions or comments at this time, and you can copy down Tony's contact information